We're back with the commodity report. This is on every week on at Monday at 11 a.m. Eastern time. So, kind of going through some basics. What have we been seeing the last couple of weeks, especially in the commodities market, which hasn't been pretty. Let's just say that it hasn't been pretty. So, basically, going over the 1 month time frame. We see the Russell 2000s leading the way in futures. So Russell 2000 up over 9% right now in a 1 month time frame. So that's been showing a lot of breadth kind of widening. We're seeing a lot of stocks going up that haven't gotten much love lately, which is good. That's the normal lifeblood of a good bull market. So lumber is right behind that up 4%. So that's interesting. The yen's up behind that, which is also very interesting, up 4%. Orange juice up almost 3%. Hogs up just over 2%, gold up almost 2%, the pound up just over 1%. So we have seen a lot of strength in the currencies. It's something we have been seeing a lot that's been kind of interesting. So when you look at the currencies, you're seeing a lot of them have tried to bottom out. A lot of them are trying to move up, but lately the dollar has kind of raged back in the last looks like 8 days. So basically, the dollar started to move a little bit off its bottom. Still in a downtrend, still moving lower, but something to keep an eye on. The pound really had a major move out of July, like basically in the beginning of July, coming into the mid-month. Then it gave some back. Let's see how it ends the month this week. Then if we look at things like the Aussie dollar, it just came crashing down. But the story of the currency markets to myself has been the Swiss franc and the yen. Both of these look really interesting, saying a lot about safe havens at the moment. So this is kind of an interesting one. And oil came all the way back to it. Today. It's back at that 75 level. It's been bouncing and just kind of stuck in this range between 85 and 75. So this is kind of and honestly 72. So it's kind of interesting to continue to watch this. We've mentioned that range in the crude market many times. But something to continue to keep an eye on is, will this thing break down or will it break out? And honestly, I would follow it either way at the moment. I could make a thesis for why it should break out. I could make a thesis for why it should break down. I would follow it either way if it does happen. So, Kevin, what are you seeing in the commodity markets right now?
Yeah, I would say just kind of like you talked about, some general weakness for the most part across the board here. Now, when you're looking at energy, seeing that slide here a little bit, we had this conversation, I believe, last week or the week before last or what have you, right? Because time's flying by. We're already almost in August, which is ridiculous. But you're seeing crude oil actually sell off here. We have seen some actual, positive dynamics when it comes to gasoline demand. We did just recently overcome the 2023 levels at this time last year. When you're looking at the 4-week average, as well as the 4-year moving average of that 4-week moving average. So those two dynamics are actually bullish when it comes to gasoline. The problem that we have is the inventory levels continue to increase more than what the demand picture is showing. So we kind of talk about this calculation all the time. You have what you produce, right? You have what you consume. And then at the end of the day, you have the inventory or draw within those numbers. And right now, the demand is going up, the consumption going up in some respects in certain areas. But unfortunately, the inventory buildups that we are seeing, especially on the byproduct side of the last couple of weeks, is something that's putting a little bit of pressure down there. I think you're also seeing a little bit of a slide to the downside because of the macroeconomic data that we're getting pretty much across the board, right? We are signaling that we potentially have some slowing that is taking place. China, in fact, is not expanding the way that we thought it would be. And in fact, there's a concern that they might be actually spiraling into a little bit more of a slowdown here in the near term, which is not good. And then for the United States, you look at manufacturing PMIs, those are in contraction. Services PMIs just went into contraction. Prices kind of continue to stay elevated. We may have a labor market that's starting to turn over here. We'll get a jobs report on Friday. So I think the macroeconomic factors, along with the inventory builds, is really putting some pressure on crude. One area that we always talk about here is the 200-week moving average, and we are now officially trading below it, Jason. The 200-week moving average right now is sitting at $77.54. We're trading at $75.77, give or take. The 210-week moving average, which is the natural moving average that we would focus on, is at $75 even. So let's see if we're going to actually get a break off of that a bounce off of that or not. We talk about this dynamic here over the last couple of years. We've been able to bounce off that 200-week moving average. And if that's going to be the case and we violate now, from a technical standpoint, not a recommendation, you would maybe hope for a little bit of a technical bounce, maybe $1.50, maybe $2, maybe for a scalp. But once again, the primary trend is continuing to be in the downside here. We kind of have this descending channel that is taking place. So that's kind of what's happening on the crude oil side, and now on the gasoline side here. What are your thoughts when it comes to energy and when you're kind of looking at the charts and maybe some of the fundamental dynamics that are out there?
No, I wanted to actually pass something on to you, because as I was looking at the curve for futures on crude oil, gasoline, and so on, just kind of looking at it and going, man, Kevin would be the guy to kind of talk to about this as well, because we're kind of seeing some tightness is kind of showing up in the market in some of these spreads. So I'm wondering if you looked at any of that lately, because I'm seeing that, you know, sometimes you see these things happen in the commodities market where supply is kind of tightening, the curve might be tightening, and this creates these pullbacks, but usually they're very buoyant pullbacks, meaning they bounce kind of quickly. So I'm just wondering, you know, what are you seeing in the futures curve right now for crude oil?
Yeah, so for crude oil, we're still technically in a backwardation. So that's where the front month contracts price higher than the further dated. So that's still bullish, right? That means that there's still a concern about near-term demand and draws there. Now, I believe that we have actually gone through a structural shift when it comes to crude oil, though, and looking at that curve moving forward. I mean, we haven't had a contango type of market in probably 2.5, 3 years. Actually, probably since COVID, and rightfully so, right? We had COVID, we had this massive buildup, we had energy companies really paying down a lot of debt. Their strategy for expansion, especially when it comes to rigs domestically, has shifted, being a little bit more light, a little bit more nimble. And they're trying to perfect as much as they possibly can this just-in-time inventory. And so when you're looking at that curve, you're not really pricing in storage cost. I mean, you're still pricing in transportation costs because logistical lines have gotten adjusted here. But for the most part, we're still in that backwardation of the curve, which is probably the number one thing that you need to be able to sustain a bull rally, right? And if we actually see a flattening of that curve and then we go into contango, meaning that the further dated contracts are priced higher than the front month, that's where you have supply gluts really being priced into the market. You're seeing the same type of thing happening in gasoline. Gasoline is still in a backwardation curve right now, a little bit more seasonality when it comes to that curve. So we have to be mindful of that, right? Summer months warrant a premium, different blends in the summer months rather than the winter months. So that is not actually surprising. Heating oil, though, is something that is more of a flattened curve. It's actually in contango. So that's kind of that first contract that we've seen not only violate and sustain under the 200-week moving average. Is the first one that we saw demand actually breaking down. That's not surprising, right? Transportation, when you're talking about actual logistics, is in a recession right now. I would call it a recession. And then we had these buildups. So once again, that's already in that's already in contango. What you don't want to see is those two other contracts, gasoline and crude oil, getting in to contango as well, because that would be ultimately bearish when it comes to the energy market as a whole. So once again, if you're a tactical, technical type of person, 200-week moving average, you can make a case that we could see a small bounce off of that, right? And just price in a small bounce, right? $1.50, maybe $2. That's a very small bounce. But if you're looking at it from a longer term trend, seeing that downturn seeing the downtrend moving, seeing the 200-week being violated so many times in such a short term time frame, you get a little bit concerned about that. And unfortunately, for those that might just be tuning in, because this is getting a lot of traction, if that 200-week moving average, there's a very strong correlation between crude oil breaking below the 200-week and then what actually happens with the economy, as well as the SPX, or if you're looking at the equity market as a whole. So from an economic standpoint, you want to be able to maintain that level. Now, if we can stay around 200-week moving average, good, okay. Maybe we have some stabilization when it comes to inflation, but a further or a continuance of a breakdown to the downside, let's say you get down to $60 or $55 when it comes to crude, that's where you would get very concerned that maybe the macroeconomic landscape is not looking so great.
No, well said. I think there's just so much going on here in the energy space. And another question that came up, and the first question that came up today was about actually natural gas. So if we look at natural gas coming up here, what are you seeing in the natural gas market? Because everybody wants to talk about that. For myself, it's crashing down. It's happening pretty quickly. We're seeing these major levels, like we're kind of sitting on a major level right now, sure, but natural gas isn't something that like you ever want to try to buy dips in. So what are we seeing fundamentally in the natural gas market? Because that was the first question we got today from Sam.
Yeah, so in the middle of June, we saw natural gas hitting that $3 level. And we kind of had this conversation of how sustainable is it going to be here, right? We know the inventory buildup dynamics that are in natural gas is unlike any other energy product that is out there right now, where we just have such an abundance of it that we flare it out in some respects. So you got to have a demand story that's there, and the demand story for natural gas and what you can see from a secular trend type of scenario is going to be liquefied natural gas. But unfortunately, we don't have the operations in place to be able to scale that up right now. So there's really tight supplies when you're looking at LNG, and the demand for exports is still robust in some sense. We are seeing a little bit of weakness when it comes to China. They're kind of replacing liquefied natural gas with coal in the near term. But over the long term, when you're looking at Natty, what do you need for the next couple of months? We're in a summer period. So if you get hotter summers, that means theoretically electricity demand goes up, right? And if electricity demand goes up, natural gas is the biggest provider of electricity right now here in the United States. So that could be your demand driver that is there. You'll also have a fall/winter play that you and I will talk about probably once we get closer and closer. You're looking at that October, November timeframe where natural gas starts to we start to draw on natural gas. In the summer months, we have injection season. That happens pretty much around April or May. And when we mean injection season, that means that we're putting natural gas back into stockpiles. And then in the winter times, we take natural gas out of the stockpiles because we're using it for heating and other things, electricity and things of that nature. So you're already going to have a pretty decent headwind in the summer months if we don't get heat. And fortunately, if you're kind of looking at it from a broader scale, just the US, it hasn't been that bad when it comes to the heat cycles here, even though we had projected an extension of around 14 days of hotter days this year than what we had last year, which is another reason why we saw that mini bounce to the upside. That just has not come to fruition. And that's also kind of being translated into the grains. I won't go down that road there. When you're looking at areas of support, 190 is an area of support for natural gas. It seems like that's when we start getting buyers to step in. That doesn't mean it can't go lower than that, but that's when we tend to see buyers kind of nibbling a little bit. And if you're looking at short interest or the commitment of traders, it's not as aggressive on the short side like we've seen in the past. Now, that could be a good thing, or that can be a bad thing. That can mean, hey, we have more shorts that can actually be placed in this market and continue to push price down. Or you can look at it on the other side and say, there's a reason for that. No one wants to really be short this because of the recent spike that we had, and then also the seasonal factor. So I'm not trying to say like wishy-washy here. It's kind of a 50-50 type of scenario. Europe is also another big importer when it comes to LNG as a whole, right? And so their natural gas stockpiles are at elevated levels, and rightfully so, especially when you have geopolitical and war premium that's being priced in. Any type of draw on that inventory early on, or any type of disruption of natural gas flows there, can also put a bottom in for Natty. I just think that this is just regular range bound type of movement. Maybe it just ranges out here. But from a technical standpoint, it gets really hard to sustain $3 without a fundamental catalyst. We actually just got the rig count from Baker Hughes. We also put in 1 or 2 rigs last week, if I'm not mistaken, just for Natty alone, right? Not even looking at Permian, just looking at Natty. And so the increasing of rigs also means theoretically that more supply will hit the market. That's also bearish for Natty. But we're at levels right now where it makes it for a very difficult short, even though you have the fundamental catalyst to be able to create a short position or come to the thesis of a short position. You don't really have that much wiggle room to the downside. Now, if you say, it's trading at $2, you say maybe $1.90, $1.85, maybe you can get a bid. risk reward, right? You're going to try to scalp $10,000 off per one contract, right? You're going to try to scalp $10,000 off one contract, or I'm sorry, if you're going to try to scalp a couple of thousand off of one contract and basically have 10 grand worth of risk on upside risk, right? When you're looking at the resistance zone, to try to scalp maybe 2 grand, 3 grand, doesn't seem like the risk reward is really there. If you were going to tactically structure it, not a recommendation, we talked about this before it actually hit $3, right? You can look at going out on the options. Maybe you look at the natty gas options. You can also look at UNG. UNG is going to have a blend of futures contracts that are out there, so be mindful. It's not going to have a 1-for-1 beta. It's probably going to be around a 90 beta, maybe a little less than that. But you can look at the curve, maybe try to buy a DECE option, right? And then a call option if you are bullish, and then try to sell premiums against that. And as you get these spikes in volatility and spikes in prices to the upside, you can just continue to roll those premiums out and basically try to just do a diagonal is basically it, or even you can look at a calendar, or you can look at a I'm more of a fan of diagonal spreads than calendars, because you kind of got this weird skew when it comes to the profile. So you could calendar it out and say, maybe you look at the 205s, not a recommendation. Look at the 205s and you try to sell the 260s against it. And if you're doing that on a weekly basis based on the options, that's a healthy amount of premium over time. And if you do get that vol spike, and you do get that, when I say vol spikes for natural gas, the reason why I say when you get that vol spike is because vol is actually inverse on natty, just because of the structure of the product. So usually when we see vol spikes, that's when we also see price spikes to the upside. It's the opposite when you're looking at some of these other products where volatility goes up, and then there tends to be the relationship, or that opposite relationship of prices going down. Natural gas is not one of those products.
No, well said, and I hope everybody got a lot out of that one, because there's a lot to take in on natural gas in general. Like, it's a very tough to trade product. I think you have to figure out how exactly you trade it. No matter how you trade it, though, trade it small. It's the most volatile product in history. Sure, besides Bitcoin, but Bitcoin's a new product. So natural gas, to me, is the most volatile product in history. You're going to have a lot of periods where you're going to have these pullbacks, just smack every single position. You're going to get chopped to death in it. You're going to be underwater on positions for a long period of time. Just be very careful trading natural gas. And I don't even think it's careful. It's more just understand position sizing about trading, and understand that as volatility increases, you want a smaller position size. So you want to hop into, actually, I know you sent me a chart. Before we get into that, let's bring this chart up that you sent.
Yeah.
So what are we looking at here, Kevin?
Yeah, so this is just a super basic chart, but this is just showing U.S. gasoline demand. This is the implied demand by the EIA. So it's an estimate. But that green line is going to be 2024. We see that kind of bounce to the upside. And actually before then, these are on weeklies. But if you're looking at in May, we were actually below April and May. And April was actually the big concern when it came to gasoline consumption as a whole. That's where it kind of started creeping up around the consumer. And I'm gonna, me, man, I gotta go on a little bit of a tangent here. This is a perfect example, and here's the reason why. This is a perfect example where commodities can tell you so much more than just the price of that commodity, right? Mm-hmm. We see that divergence basically from April to mid-May of gasoline demand itself. And yeah, we might have a little bit of seasonality, but if you're kind of looking at that divergence, it was a little bit more aggressive. And if you kind of remember now, if you're looking back, you're probably thinking, oh yeah, in May, that's when people were kind of talking about the stress of the consumer a little bit more than what they were talking about in the past. And this is where commodities can say, yeah, that's where you're looking at. I mean, you're talking about it's a consumer staple for 99% of us in this world, one way, shape, or form, right? For us, for transportation, let's say 85%. So you saw that divergence. That's kind of your first sign of, hey, there might be some broadening weakness happening. That also then coincided with the weak retail sales numbers and things of that nature. Okay, cool. Now you're starting to see that trend really reverse. Now there's two reasons why we're kind of seeing this. One is export demand has improved a little bit. That's going to be one. Two, You are going to see some residual effects from Hurricane Beryl. All right. And that kind of disrupted for a very brief time, but disrupted flows between the United States and Mexico. So the U.S. sends oil over to Mexico. Mexico sends over refined products to the United States. So that's going to have another thing that kind of why we might be seeing a little bit more of a blip to the upside here, or this advancement. But this is one of those bull signs. This is not the only bull sign, but this is one of those bull signs that you say, okay, the consumer has recovered for gasoline demand for now. We just need to see that follow through. And if the consumer is actually fairly strong when it comes to gasoline demand, but your inventory or your production levels continue to increase at a faster pace than consumption, then you have inventory builds. Super simple concept there. So that's all I wanted to kind of highlight. We see the price action to the downside. We are seeing some green shoots when it comes to implied demand. Now, these numbers can be revised when we get the monthly numbers, but overall, I think this is a bright spot in a time where a lot of bearish factors are taking place in gasoline.
No, great point. And somebody mentioned that there's no sound. I feel like other people would have said that if there was actually no sound. So check your settings, make sure there's some sound on there. Also, I checked the health of the live. It looks like it is loud. Also, if you guys have questions, for basic commodities, currencies, anything in the futures market, please write into the chat. We're happy to answer any questions. So Andy says sound is working for him. Like I said, I think it would have been coming up. So sorry that you're having problems. But okay, so let's go through the next thing. So people wanted to talk about gold, and they wanted to talk about gold. Everybody wants to talk about gold, especially because it's in an uptrend. It's a hot one right now, and I'm also a big fan of gold as well. Not because of trading wise, it's a trading tool for me. As a trader, I'm just going to trade what's in front of me, trade the trends and so on. But it's also something I hold. I like to hold gold. I think it's a way to kind of keep your money, have some value, keep your wealth a little bit above inflation over time. So basically, what are we looking at here with gold? Are you thinking that gold is going to be a thing that is going to continue this uptrend? Do you think it's going to chop around? For me, looking at it, I see that it's stuck in this range. And as we're kind of stuck in this range here, let me bring up a chart. As we're stuck in this range here, I'm seeing that we're just kind of stuck. We're not really going anywhere. I'm not really very bullish on it right now, or bearish. However, the long-term trend is up still. So we're still long gold at the moment, but I would really pay attention to these levels of 2270, 2279. We start to break those levels. We start to sustain below those levels. I wouldn't be as bullish on gold. Kevin, what are you seeing on the fundamental side of gold?
I would say, yeah, I mean, your bottom support level right now, and you asked for fundamentals, let's talk about technicals. 2300 bottom range to 24, let's call it 2500. Top range, right? So if we break up 2,500, you break down that 2,300 level, that's where you would get a little bit concerned. Okay, so for me, and just looking at the history of gold tends to consolidate a range bounds for several years, right? And then we have a breakout to the upside or downside until it finds its new range, and then it kind of trades in that range. I feel like that's where we're at right now. Where we kind of had, and maybe we're not done with that breakout yet, but I feel like we moved up. I would have said that we moved up way too far, way too fast. And this consolidation is just allowing that. It's a consolidation of time, not so much consolidation of price. I always talk about that too. So that's a good sign. But I think that we see kind of gold range bound, being range bound here, unless something once again kind of shifts. Now, let me put on my tinfoil hat, because we're getting up to the elections and we got a whole bunch of stuff that's happening right now, right? You could see maybe gold catching a little bit of a bid as we have geopolitical or election risk, in October, November. I would not be surprised by that. You could see election trends in the past. That could be something. I'm not sure how much that's going to sustain itself, but that could be something. I look at gold and say, okay, what can get additional flows for gold? Additional buying or an increase in buying from Federal Reserve banks or just central banks. We've seen China kind of hold off, and might be nibbling in a little bit, but we can see an increase there. And if we do, maybe it's a diversification or maybe some other financial instruments that might be within their own economy that might be weak, right? If you're looking at China, you're looking at real estate. Real estate could be one of those areas. If you're looking at Japan, yen weakness, right? And maybe that's going to be something they can kind of shore up their GGBs with. The United States, I think we're pretty good on the Treasury side. I mean, there's been a lot of yapping and talking about the Treasuries and like, oh my God, look how much we're printing, look how much in the auctions. We talked about this a couple of months ago, right? We weren't making fun of it. It's a serious thing. It's a serious thing, but understand that they've been talking about that same type of scenario for the last 50 years, 40 years, 50 years, and nothing else is fundamentally broken yet. And you're looking at yields right now trading at 4.1%, which I think have gotten a little bit more aggressive to the downside than I would have expected. So yields are lower, auctions look decent, so that could also then provide some stabilization. So, and then the other side of that, do you see inflation coming back into the picture? Right? Do you see dollar weakness? Dollar weakness should actually happen. But we haven't seen that very strong correlation between gold and the dollar over the last couple of months. And so I'm just a little bit weary of putting my hat on that. Man, back in the day, it used to be like, I don't even have to look to see what gold's doing. I can just see what the dollar's doing, and I can tell you exactly what happened to gold. That's just not the case anymore. So for now. So I think for gold, we kind of range bound here until we get something that either fundamentally breaks, that causes a scare, and you look for hard assets to get in, like as you talked about, to preserve capital, I guess. Or we have a scenario where we have a soft landing and maybe we don't have to push gold higher here. It's a nice trend, but once again, I think that breakout was pretty decent. I think we just range bound here in the near term. That's just my 2 cents though. And here's the big test. The big test is going to be on Wednesday. If Powell signals to the market that, yes, they're going to officially be cutting rates, which I would assume so right now. I mean, if he doesn't signal that, then we got a huge unwind in Fed funds. And y'all better watch out because that will be very messy. And so if he does signal, hey, we're going to be cutting rates, yields probably have already been pricing this in, but theoretically yields could go down, dollar could go down and weaken here a little bit. That could also give gold a little bit of a push to the upside, but I think the market's already pricing that in. I think that's what we are already seeing reflected right now. Yeah, that's what I got.
Yeah, and I mean, if you go further out and you look in the Fed rates and you see the Fed rate probabilities, you're looking at a cut in September, and that's over almost 90% right now probability. And when you see that, usually most of the time you're going to see a cut, most likely. It's very rare that we get to those 90% levels and we don't see a cut. Sure, like there's been times where it's happened. Sure, that it has happened, but I would be very surprised here. At the very least, because we got to trade what's in front of us, and what's in front of us is exactly what Kevin said, is July 31st at 2 p.m. I think I would be very surprised if anything comes out besides him being incredibly dovish, talking about the cuts incoming, and everybody agreeing on it and so on. Like, I think that's going to be what we're going to see going forward. Yes, I'm sure there's going to be a couple people who disagree, but I think they're going to most likely cut in September. There's just too much pressure here in a lot of different areas. And sometimes too many people, they look at it and they look at it in one way and they look at it just the stock market only, but there's so much pressure out there, the labor market and so on. There's a lot of pressure for the Fed to probably cut. And usually what you see in the election cycles, you usually see a liquidity kind of come into the market around election years, either the election year or the year after, and also the year before the election at times. So you see the most coming in, though, during the election year. A lot of the times the candidates are talking about, you got the candidate coming in saying they should raise rates. You got the candidate going out or possibly running for its next term saying they should cut rates, which usually leads to some form of liquidity starting to come in the market. And I think something that we have to also pay attention to is that a lot of these central banks have already cut. If we're looking at the ECB, if we're looking at the Bank of Canada, some of these have already cut. So, we're not seeing, and also we're all across the board. Remember when negative rates were a thing? It's kind of interesting now to see like even the most negative rate, which was the Bank of Japan, is even a positive rate at the moment. So up 10 basis points. So, across the board, we have positive rates for the Fed rate. I think they gave themselves room to have what they used to call ammunition. It's kind of funny to talk about that because I used to say that word all the time. We have ammunition, bazookas and so on. There's all these terms for these things, but now I think they have enough room to have some ammunition to possibly, cut rates across the board if they want to. At the very least, going into year end, I would assume we're going to see a rate cut. I'd be surprised if we didn't.
Yeah, I agree with you. And I was the proponent of like, don't cut yet. And now it's shifting a little bit. And the reason why I say now it's shifting a little bit is because we are seeing the back end of the curve actually responding. So when we've had these false starts before, it was the front end of the curve getting ahead of itself, right? It was the 2-year doing too much. Now you're seeing the back end of the curve actually moving a lot quicker. And so we're getting close to that inversion of the curve. And that could be actually a pretty volatile time as a whole here. And that uninversion of the curve, knowing that we have the rate cuts on the horizon, just shows the maturity of the market. Let me talk about the maturity of the fixed income market to finally understand and bow down and say, okay, like this is the right way to do it. If you have the opposite happening and you continue to have the adjustments on the front end of the curve, that front end of the curve has an immediate impact when it comes to near-term rates in general, right? Credit card rates, maybe not as dynamic, but if you're looking at car loans, if you're looking at mortgages, right, you're looking kind of more of that blend between 5-year and say the 7-year. And actually a lot of mortgages now are being priced off the 7-year term mortgages because they churn so much. So that was the problem that we had in the past. Now it's a little bit different. I still think the Fed is going to have an issue. I don't think we're going to be in a Goldilocks scenario. Maybe we are in Goldilocks for right now. I still think the Fed is going to have a problem. And the problem that I believe that we are going to have is going to be sticky inflation. We will not hit our 2% target. I would be very surprised if we hit our 2% target by the end of 2025, going into 2026. And if we do, then once again, I think we have a little bit of an economic downturn that does kind of take place here. I'm of the belief that you can't have stabilized demand and lower prices without supply hitting the market, right? Like you need to have one of those things fail. And unfortunately, the big thing that does usually fail and actually shores up the demand story is labor and jobs. And I think that will be the next shoe. And that should be everybody's ultimate focus here moving forward. It's no longer going to be inflation. Like understand and accept the fact that inflation is going to be at 2.5%. I think if consumers can understand that, or you prepare yourself from a budgetary standpoint, let's get outside of let's get outside of the trading aspect. If you prepare yourself for 2.5% inflation normalized, you should be sitting pretty. Because like, what's the worst that's going to happen? Like if it stays and maintains and it continues to be sticky, right? You're at least prepared for that. If it goes below that, you'll have additional purchasing power, right? So just be mindful. The Fed's not going to ever probably admit that they failed, but this does look like an abject failure for them in a sense, and it's an unfortunate situation. But they kind of sold the market on a dream that I don't think is ever going to be possible. So that's my high level. And that doesn't mean, because of that macro view, does not mean that I'm bearish on equities or bearish on the markets or this uber bear, right? We separate macro from the trading side of the equation. And I think there's bright spots like we've talked about in the past where they actually do thrive in that particular market. If you're looking at utilities, they have more pricing power. They've had pricing power. Look at what utilities, I don't know what it is today. Actually, we did reverse. Last time that I checked, utilities was actually the number 2 sector year to date. Sector year to date. Let me say that again. Utilities was this was like Thursday of last week, the number 2 leading sector year to date. It actually had more gains than communication services as a whole. Okay. Understand that dynamic. They're going to be able to outperform. Looking at consumer staples, yeah, they've been a little bit under pressure here, but now they kind of washed out the pricing pressures and things of that nature when it comes to cost, and they've been able to preserve margins. I think that's also going to be a space that that can thrive in this type of environment. And yeah, so it doesn't mean that you have to be a bear, but that's kind of my view here. I think we are, for the bottom 50% of the United States and the consumers there, that people forget all of the time, and which is unfortunate. These individuals have been under pressure for a very long time, and it's just signified by Capital One's charge-off rates. If you're looking at Discover's charge-off rates, if you're looking at even just the makeup of labor and what's been added for jobs, and we've actually been losing full-time jobs over the last couple of months. Actually, it's been like maybe 4 months, 5 months. I mean, there's stuff under the surface that says, hey, we are weakening. And, you know, it took too long in order to do it. The Fed took way too long in order to enact policy, in my opinion.
Yeah, I mean, I agree on the idea of inflation too. Is like you have to just understand that most likely it'll be sticky, and if not, be prepared for it. And I think that's great advice for viewers out there, because there's a lot of people who watch this who aren't trading in the markets or not trading commodities, and there's things that you have to do even as a trader to understand. And how do you take care of your life? How do you take care of your family? How do you take care of things around you if you're not planning like that? And so you just kind of have to understand that there's a lot going on here and a lot of different dynamics. I think for me, looking at the market, I see that the Fed has they're always behind the curve. And I think this is something that you guys building Fed models or trading models, you guys can do this again and again, which basically you go back to 2020. This easy example, the easiest example you can ever use, which is you go back to 2020 and this chart. Let's go back to 2020. So if you look at this chart, you go back to 2020 and you say the Fed's going, oh, great, we got to cut rates. Obviously, you know, they shut down the whole economy. The Fed obviously had to cut rates to zero. And then basically going, there is no inflation, there is no inflation, there is no inflation. Inflation is transitory until they had no choice but to then start raising rates. So you can start to build your models and go, okay, well, the Fed's usually behind the curve. So how do I trade that? How do I put that together? Understanding that inflation building under the surface, finding different sectors. And I'm a person who I don't believe that the Fed always cutting rates leads to the money always going into commodities. Some people believe that, but the supply and demand destruction that happened during COVID was incredibly important. And it's the same reason why Kevin said now it's still like it's still a supply story. You can't, the Fed's not going to come out there and start printing more copper. They're not going to start printing more oil like that. That's impossible. So they can't do those things. And so them coming out, lowering rates here, as we're kind of seeing some problems as we're seeing, and even the idea of what Kevin was talking about earlier, looking at the curve, you know, we don't know what some of these companies are seeing. They might be pricing in certain risks that are ahead. Which we all know, and Kevin and I have talked about it a million times. There's a lot of risk out there that could happen to any of these commodity markets at any moment. So it's kind of like the dynamics are ever shifting because of this. So I think it's important to just kind of understand, like, hey, yeah, they could cut rates. I believe that it's kind of with me seeing inflation right under the surface so heavily, I think it's kind of a bad time to do so. However, I'm not the one enacting policy, so it doesn't matter. But as a trader, I'm going to try to pay attention to the possibility of inflation moving up, the possibility of something bad happening also, which usually happens after a few rate cuts. Usually some sort of event comes into play after a few rate cuts. Not that they bring it on, just saying historically something usually happens when they start to cut again. So we'll see what happens here. I think it's a really interesting conversation. And some people wanted to get into, unless you have another thought on that, Kevin.
Yeah, just real quick. Because if this is your first cycle, just be cautious. There's a lot of chatter, especially from inexperienced traders that have not experienced cycles that are now quote unquote mainstream on certain platforms, right? Be very careful. Look how long it took for interest rate policy to affect us to the downside, right? It took us almost a year. It's a year and a half, almost going on 2 years right now. what do you think one rate cut's going to do, and how long could that actually have an impact on us? So just be mindful. It's not like they're going to cut rates and the next thing you see out on the streets is going to be consumers partying and everybody throwing dollars around. That's not how any of this works. But I you know, we laugh, but dude, I really do believe that some of these individuals actually believe that. They actually, when you're talking about interest rate cuts, and I know we want to move forward. All right, so regional banks are catching a bid right now. That is nothing out of the ordinary. We talked about that 6 months ago, that this is going to be the scenario. This is nothing new in this process, right? They're going to cut rates. Regional banks are going to have the pressure alleviated from their balance sheet, okay? And then theoretically here in the near term, that should actually have an immediate impact when it comes to margins. It should be immediately accretive, all else being equal. But the problem that you have there is if you're cutting rates and you do see demand falling off, then you got to ask yourself, where's the top line growth story going to come from regional? No one's asking that question because we're not there in that cycle yet. Okay, so you get your rate cuts, you do your regional bank thing for right now until you don't be the last one out of that trade, right? It's a decent trade. It's not a surprising one. People are having epiphanies like, oh my God, look at regional. It's not, and then you need regionals in order for the Russell to go up, right? Look at a regional. I'm not saying you, but look at a regional bank chart. Things screeching to the upside, rightfully so. And then the small caps are going to do the same thing. But be mindful. It took us a year and a half, almost 2 years for the rate hiking cycle. It's going to have the same type of impact when you have the rate cutting cycle. And at some point, 2 quarters down the road, 3 quarters down the road, it's going to be very difficult for financial companies to expand on the top line without cutting expenses. And they cut when financial companies cut expenses, they cut. They're not doing this minuscule thing. They will literally cut 20%, 30% of their labor force and then build up after that. And usually that happens at the end of the year. So the end of this year, and usually every year, once you get past Thanksgiving, because they don't want to do it before Thanksgiving, and then they do it usually 2 weeks before Christmas, that's when you're going to get the Goldman Sachs layoffs, the Citi layoffs, the Wells Fargo layoffs. That's when that stuff occurs. This is nothing new. Okay, so ride it while it lasts, but just understand profitability takes both top line growth or bottom line margins, and cutting rates it gives you the margin story for regionals. It gives you the balance sheet story for regionals. It does not give you the top line growth. And in fact, we'll probably see a significant spike in refinances. And then we got to figure out, and we'll go to the next thing. Then we have to figure out who's going to be buying up all that paper at that point, right? Because we know that that's a wave coming. Who's going to buy up that paper?
No, I love that. It's we have to also always say these things because one, we're here to like really actually help people to trade. Like we're not here to fearmonger. We're not here to tell you what is or what isn't. We're just here to tell you what's sitting in front of your face every day. And this is kind of just what's in front. It doesn't mean it's going to go down exactly this way. It just means historically this happens. Pay attention. So getting to the yen. So this has been unpopular, and like it's funny. I haven't brought up this chart on this platform in a while, and also just for you guys who hate me because I use the JPY to yen or the yen to the USD chart. I'm a futures trader. The charts always come up this way, so I have to just
be a normal person.
Yeah.
Normal people look at pairs.
Yeah.
Normal people look at pairs.
Yep. So anyways, when we're looking at this kind of going, okay, well, the yen has been in this nasty downtrend. And the first thing I noticed when I brought this chart up is this major volatility squeeze that happened into this massive move down. So all these people are kind of, I think the reason why some of these trades get so popular, there's a couple things. One is it's low, like in someone's head. It's been falling for a while. It's cheap. I think I want to buy it because it's cheap. We all, as traders, you know that cheap can always get cheaper. For me, I wouldn't touch it here. However, if this thing starts to break trend and so on, like maybe I'd get more interested. Maybe Kevin has a different perspective on that as well. But I'm not interested in this buying this at all just yet. I wouldn't think to buy it. I don't want to buy it. I don't want anything to do with it just yet. So I would just kind of pay attention to that and watch for it to really break trend. I mean, it's nowhere near any 50-day, 100-day, 200-day, 52-week highs, nothing like that. So the yen is in a nasty downtrend. Japan also has a lot of problems ahead. So I don't know exactly what I would do with this trade, but if it did start to move up, and the one thing that we have seen this bid lately, and it gets to Andy's point, he brought up that XLU, and we were talking about utilities too. When we're talking about utilities and we're talking about the yen and we're talking about the Swiss franc, and I brought up those two currencies today moving. So we are actually long the Swiss franc, but we are not long the yen just yet. But we're seeing these catch a major bid the last couple of weeks. So what's that exactly about? And usually that's the safe haven trade that I haven't seen in years, honestly. Like I haven't seen the yen catch a bid for a safe haven trade in years. I haven't seen the Swiss franc catch a bid for a safe haven trade in years. So we are kind of seeing this money flowing into these safe haven areas. But also we see these types of moves, and a lot of times they're false moves in the summer. In the summer months, we see liquidity kind of flowing out of the market, people putting money in different areas. That doesn't mean I'm bearish on these two pairs. Obviously, I'm long the Swiss franc. It just means I'm paying attention to it. We'll see exactly where those end up. I just don't like the yen here for many reasons.
Yeah, you don't force yourself into a trade. And this one is probably one of the most dangerous trades that are out there right now. Mm-hmm. The strength in the yen is a good thing, because it was actually getting a little concerning at the top there. Yeah. When you're sitting like 161 and everybody's threshold with the market interpreter is like what, 151 and a half, and you're sitting 10 pips above that was a little concerning. So this reversal is actually nice. The reason why I say it's a very dangerous trade is because you never want to trade when a currency pair that's going to have a significant amount of central bank intervention, that they're literally telling you that they're going to intervene, which is so weird. They deny intervention, but they intervene. Like everybody sees their flows, but then they're like, well, we can't really comment on the actions that we took. And it's like, oh, really? Like you weren't the one that was just put in $200 billion worth of, funds into this particular currency here. You weren't the one that actually moved this thing for 500 pips. Like that wasn't you. Okay, that was the other guy. It was somebody else with deep pockets. So trading against the central bank is hard, and I would not advise anybody to really do that. If you're kind of looking at it, I would suspect, just on fundamentals alone, I'm not talking about technicals, I would suspect that we continue to see the yen gain strength here. The U.S. interest rate cuts will help them, right? Because it should push the dollar down. And so the currencies across the board, if you're looking at the yen, Canadian dollar, Swiss franc, should be able to strengthen on that policy alone. And then if you do actually get a rate hike from the Bank of Japan, and they come out with rhetoric that says, hey, we're going to stop the stimulus buying of these ETFs and the treasuries and all the other stuff that they buy. They buy a lot of stuff, guys. I mean, you guys are mad about the Fed and what we're doing. I mean, they go all out
way
when trying to stimulate. Yes. So if they kind of come out with that stern type of commentary, that could also strengthen the yen. The thing that's going to give the yen the strength, and this is going to sound so crazy, the thing that gives the yen the strength is whatever policy provides the more destruction for their economy. Mark my words, that is actually what the market has been calling their bluff the whole time. Oh, we're going to do this. Okay. Continue to run it up. Oh, we're going to do that. Oh, okay. And then they came out and they did their little 10 basis points, and they're like, oh, we're going to still be buying ETFs and all this stuff. And the market's like, okay, well, that's not restrictive policy. Nice gesture, but that's not restrictive. And then they continue to move up. So the market wants to hear them say, look, we're done with all the stimulative factors here. We're pumping the brakes. And unfortunately, when they pump the brakes, they will have a problem. But the goal is for the yen to actually gain some strength. And if it can strengthen faster than the problems that are going to come in the near term, that's where they're going to have the longer term benefit. Because if not, they're looking at going through another stagflationary cycle. And the last one that they had took, 20 years, 15 years for them to try to at least attempt to get out of. And they're trying to do that right now. But if they go and do the same stuff that they just did 20 years ago, which is, in my opinion, it seems like they were on that path, that's where you're going to get the yen to weaken. So that is the unfortunate scenario when you're talking about that central bank is destruction is actually good for their currency. Whereas any other currency, we would say, hey, no, like restrictive policies is not good for your currency.
No, I agree, and I think in general, I mean, like you said, if you take a long-term chart of Japan, just not the yen, but the stock market, go back to what is it, the late 80s? The late 80s, you have this huge bubble top in Japan. I think it literally just started to touch that resistance zone this year. Like that was good over 30 years of just complete stagnant growth, not able to make a new high after this crazy bubble top and after all these all these monetary policies that they've gotten into with extreme negative rates, extreme basically trying to just kind of coming in and intervening a little bit too much. So if we're looking at the Aussie dollar here too, it's another one.
I'm sorry. Let me capstone that real. Now they are going to see a benefit when it comes to energy, because Japan buys their oil in yen. There's a weird structure. It's not even a weird structure, but it's the way how they're able to do it, and they kind of peg off dollar but buy in yen. So the yen gaining strength here and crude going down is actually going to be a benefit for them, because Japan imports what 80%, 85% of everything. They're not really self-sufficient, and so they have to import all of their energy. So that'll actually be a tailwind for them if these trends continue. That's all I would say.
No, great point. And so let's get the Aussie dollar, and so when you look at currencies, something that's also important to think about is that there's commodity-based currencies. There's safe haven currencies, and I call the dollar the panic currency because you'll see these massive spikes in the dollar. It doesn't mean it doesn't trend. It doesn't mean it doesn't move, but you'll see the massive spikes in the dollar really come when everybody has no idea where to go anymore. In early cycles, like you'll see, let's say we're in a downtrend and everything's heading into a bear market, you'll see this major trend, and it'll happen in bonds. So people start to run out of so basically the market goes through a bunch of different phases. The first phase is they start to get into utilities, they start to get into staples, they start to get in these safe haven ETF areas, basically the sectors that are safe havens. And then then those start to move down. And then they start to move into things like gold and bonds. Gold usually starts to fall, then bonds usually start to fall. And then the last thing that they start to get into is dollars. And you'll see that, and you can go back to even 2020 is a good recent example. You'll see this massive spike in the dollar. 2022, you also see a big move in the dollar. So people kind of run into the dollar at those periods. The Aussie dollar is really it's kind of a commodity-based currency. It hasn't had that same weight the last few years. But basically kind of looking at it and going like, yeah, it had a nice run when the commodities were really moving. It's kind of moved off. I see it's really tied to copper anymore most of the time. Kind of looks very similar to a chart of copper, but not lately. Lately, it's just looked pretty rough compared to just about anything. We did get a buy signal for the Aussie dollar once. It gave it right back within minutes. It literally was like the next week. It basically came right back the other direction. I don't have a big view on it either way or the other. Our trend models are right in the middle. It's just neutral on both sides. I would keep paying attention to it. If the commodities are going to start to move, I would expect the Aussie dollar to start to move. But really, there is nothing here telling me to buy the commodity currencies like the Aussie dollar or like the Canadian dollar, either one. The only thing that is bullish for both of these is there's a lot of commercial buying. The COT reports, especially on the Canadian dollar, look amazing. So there probably will be a bounce in these things, but a general trend change, I would want to see a little bit more out of here. I'd want to see it start taking over these major levels, get above 60, get above 67, get above 68. Once we really start to get above those levels, I'd get a little bit more bullish on the Aussie dollar. But at the moment, I'm just kind of sitting on my hands.
I'm going to be honest with you. I don't really have any comment outside of what you kind of covered there. So I think once again, dollar goes down, I think a lot of these currencies will actually catch a little bit of a bid, but I don't have anything outside of what you kind of covered and the relationship that you're seeing. I mean, Australia is a huge metals complex, right? So that would be the biggest tailwind for them. I mean, if you're kind of looking at the chart, though, it does appear that it may have bottomed out, right? Making higher lows on a relative basis, maybe forming a structured bottom, and maybe that's going to be the case where it can kind of, you know, propel from here. But outside of that, I don't have anything else to say about the dollar, Aussie dollar.
Yeah, I mean, I think it's cool that you know, people. I trade the currencies all the time. I know a lot about the currencies, so I think it's cool that people brought up some currency ideas today. So that was kind of fun to chat about. And then we'll just end off on one thing, because you know, you talked about this a little bit, Kevin, and I wanted to put this question up to you, which is utilities. Andy basically said, I think we're seeing a shift in perception on the role of XLU, being the utilities ETF, actually a convergence of two different narratives, both the safety/fear of a downturn trade and the AI energy grid trade. So I think that's a perfect question for you, man. Like, you know, what are you thinking with this kind of idea? I actually, you know, Kashop and I were talking about this a little bit on Friday, the idea that, you know, energy and utilities might start to catch a bit together, something we haven't seen in 20 years. I think we saw it in the 2000s. So what do you think about this question, Kevin?
Yeah, I think and he might be on to something there. I think there's also another dynamic when you're looking at interest rates. So when you start seeing interest rates starting to come down, anything that actually does have attractive yields, or traditionally has attractive yields, tends to be bought up. And so utilities is probably the number one sector when you're looking at it from a yield basis standpoint that a lot of longer term investors kind of look at. So if we're going to see a peak interest rate environment, maybe you look at some of those utility companies that might be paying a 3.5%, 4%, 5% yield, depending on which one you're looking at. Now, the tax equivalency of that is going to be dependent on your own type of scenario there, right, and how long you're going to be holding things for. But utilities give you very low beta, gives you the yield, and also gives you the opportunity for price appreciation. Where treasuries, if you're a buy and hold person, right, portfolio person, typically you don't really buy treasuries to try to gain alpha on price, right? You buy the treasuries because of the yield and the stability. And so I think that's one reason why you're seeing that. The AI trend, I think that's a narrative that is out there, but Andy's a smart dude. He's a smart guy. He's smarter than we are, right? So he knows this. Be careful with that. I don't... from my research, I have not seen. Will energy demand actually increase because of AI? Yes, we already know that. We kind of talked about this, and I won't rehash it. You guys can look at some previous videos, right? But it's also about the location.
Video too. I'll put it in the on Twitter and on the comments for YouTube.
Yeah, it's all about location. So be careful with that. You're starting to actually see a lot of this AI stuff. These narratives are starting to get weaker and weaker as we kind of get further and further into this structure here. But let's talk about the biggest thing about utilities is it's a sector that has pricing power. It's meat and potatoes. Like that they have had the price. Where do you think the pressure for inflation started at this year? It was energy and it was utilities. You can go back in the CPI reports. They had the pricing power. And so we're in earnings season now. They've actually had some pretty decent earnings, or at least guidance moving forward, if you're looking at Next Era Energy and some of these other names that are out there. So I think utilities provide you the cover to withstand any type of not economic downturn, but maybe some turbulence when it comes to the equity markets. It gives you the dividend yield. It also gives you that price appreciation, and then you see the diversification in their business and how they're able to expand margins with new technologies being brought online. I think that's also taking place. The AI energy trade idea is being priced into this. So you run that as much as you possibly can, but understand that at some point that will fade away in the near-term narrative. And if so, what can actually backfill that? And I think it's going to be just the true fundamentals of utilities.
No, that's perfect, and I think there once again, it's like we're going into uncharted territory, and the thing we can always look at is history and kind of going like, hey, historically, when technology changes, technology being deflationary is something that people actually have used over the years as something. If you read books on it, you'll see that comes out a lot. It doesn't mean that, I know the future. AI could be a different thing. It could be something that continues to grow. It could become self-aware, and it could take over the world like in Terminator. I'm just kidding, but kind of not kidding, kind of kidding. But anyways, though, I want to say thanks to Kevin for coming on. Make sure you guys follow him. Kevin just put out a really good video for everyone. So if you guys want to check out Kevin's page at KG Bull and Bear, he definitely has a new video out that's pretty cool on gamma levels that you're going to want to check out. Really good trading stuff in there. So I enjoyed that a lot. So make sure to follow Kevin, and we'll see you next week at Monday at 11 a.m.